The government tells you to save money. Put it in banks, build wealth for retirement, follow the rules, then they change the rules. April 5th, 1933. Executive Order 6102. The U.S. government made it illegal for citizens to own gold. Not gold stocks, not gold mines, physical gold. Citizens had until May 1st to turn in their coins, bullion, and certificates to Federal Reserve banks. The government paid $20, or $1.67 per ounce. Once they collected the gold, they revalued it to $35 per ounce through the Gold Reserve Act of 1934. Your dollar lost 41% of its value overnight. The gold ban lasted 41 years. This was not theft. It was legal. March 25th, 2013. Cyprus. 2 major banks closed. The European Commission, ECB, and IMF imposed a bailout with conditions. Depositors with accounts above $100,000 lost up to 47.5% of their money. Not investors, depositors, people who thought their cash was safe. The European Court of Justice dismissed their compensation claims in 2018. The court ruled depositors are unsecured creditors of their banks. This was not theft. It was legal. You do not lose your wealth because someone breaks into your house. You lose it because the machinery of state intervention has bottlenecks. Those bottlenecks are your bank account, your citizenship, your jurisdiction. The state does not need to confiscate wealth when it controls the infrastructure where wealth lives. The wealthy understood this 4,000 years ago. Mesopotamian merchants buried silver outside city-state treasuries. Roman elites moved assets to Egypt when the Republic collapsed. Swiss banking secrecy laws in 1934 were a direct response to the Nazis hunting Jewish wealth. The strategy has always been the same. Move value outside the system before the system moves against you. Welcome to Noob Historian. We follow the money, trace the power, and expose the history they never taught you in school. Here is why this matters to you right now. On July 18th, 2025, the Genius Act became law. The government created a legal framework for payment stablecoins, regulated, backed one-to-one by reserves, issued by subsidiaries of insured banks. This is the most permissive legal environment for alternative wealth structures since before the Bank Secrecy Act of 1970. At the same time, President Trump signed an executive order in January 2025 prohibiting federal agencies from creating or promoting central bank digital currencies. The government opened one door and closed another. The difference between the two doors is surveillance versus sovereignty. You're living in a rare historical moment, a window. The same kind of window that existed in 1974 when Ford legalized private gold ownership again. The same kind of window that existed before 1970 when offshore accounts were not reported. The same kind of window that existed before 1933 when gold was money. These windows close. This script will show you 3 strategies the wealthy have used for centuries to protect value from state intervention. These strategies are legal, they are documented, they are tested. The first strategy is geographic diversification. The second is asset class conversion. The third is structural insulation. You will learn how they work, why they work, and where the legal boundaries are today. Every government faces the same problem. It needs to extract resources from its population to fund wars, infrastructure, bureaucracy, and social programs. Extraction requires control. Control requires visibility. Visibility requires keeping wealth inside systems the state monitors and accesses. Every individual with wealth faces the opposite problem. Preservation requires protection from extraction. Protection requires reducing visibility. Reducing visibility requires moving wealth outside monitored systems. This tension is not modern. It is the oldest recurring pattern in financial history. Mesopotamia, 2000 BCE. Merchants operated under the Code of Hammurabi. The code regulated trade, credit, and property. Temple authorities and city-state rulers taxed commerce. Merchants who wanted to preserve wealth buried silver and gold outside city walls. Archaeologists have found hoards throughout the region. These were not random losses. They were intentional diversification outside the official treasury system. Rome, 49 BCE. Julius Caesar crossed the Rubicon. Civil war erupted. Wealthy Roman families moved liquid assets to Egypt, Greece, and Asia Minor. They converted holdings into portable forms, gemstones, artwork, precious metals. Geographic diversification gave them options. If one jurisdiction became hostile, they had wealth accessible elsewhere. Medieval Europe, 1200 to 1400 CE. Jewish communities faced expulsion, pogroms, and asset seizures. Families developed networks across multiple kingdoms. They held wealth in portable instruments, letters of credit, promissory notes, trade goods. When one kingdom expelled them, they walked across the border with their wealth intact. The strategy was not evasion. It was survival through jurisdictional arbitrage. Switzerland, 1934. The Nazis took power in Germany. They hunted Jewish wealth. Swiss banks responded by codifying banking secrecy into federal law. The Swiss Banking Act of 1934 made it a criminal offense for bank employees to disclose client information. This was not about privacy for its own sake. It was structural insulation. Wealth held in Switzerland became invisible to foreign governments. The infrastructure itself protected the assets. The pattern repeats because the incentives never change. Governments need extraction. Wealth holders need protection. The conflict produces three strategies: move wealth to a different place, move wealth into a different form, or move wealth into a different structure. All three strategies exist today. All three are legal. All three have historical precedent stretching back thousands of years. Gold was money in the United States for over a century. Paper currency was redeemable for gold on demand. Banks held gold reserves. Citizens owned gold coins. The system was not perfect, but it had a limit. The government faced constraints on money creation because dollars were claims on a finite asset. The Great Depression broke the system. Banks failed. Deflation accelerated. Unemployment spiked. President Herbert Hoover struggled to respond. In 1932, Franklin Roosevelt won the election on a platform of intervention and recovery. On March 4th, 1933, he took office. 2 days later, on March 6th, he declared a national banking holiday. Every bank in the country closed. The official reason was to prevent runs. The real reason was to prepare the infrastructure for the largest monetary intervention in American history. On April 5th, 1933, Roosevelt signed Executive Order 61-2. The title was Forbidding the Hoarding of Gold Coin, Gold Bullion, and Gold Certificates. The order required all citizens to deliver gold holdings to Federal Reserve banks by May 1st, 1933. The government paid $20.67 per troy ounce. Failure to comply carried penalties up to $10,000 in fines, or 10 years in prison. The American Presidency Project at UC Santa Barbara hosts the original text. The order had narrow exceptions. Jewelers, dentists, and artists were allowed small amounts for professional use. Citizens were allowed up to $100 in gold coins. Everything else went to the government. The stated goal was economic recovery. The real goal was monetary control. Once the government collected the gold, it passed the Gold Reserve Act of 1934. This law revalued gold to $35 per ounce. Your dollar now bought 41% less gold. The government engineered a devaluation without calling it one. It took the gold first, then changed the price. The Supreme Court heard challenges. The Gold Clause cases of 1935 tested whether the government had the authority to nullify contracts denominated in gold. The court ruled 5-4 in favor of the government. Chief Justice Hughes wrote the majority opinion. The dissent was scathing. Justice McReynolds called it confiscation and said the Constitution was gone. Gold ownership remained illegal for 41 years. President Ford signed Public Law 93-373 on August 14, 1974. The law allowed private gold ownership again starting December 31st, 1974. The Federal Reserve History Archives at the Richmond Fed document the full sequence. 3 lessons emerge from this episode. First, legality is downstream of necessity. The government did not break the law. It changed the law to fit its goals. Constitutional protections did not stop the seizure. The court deferred to executive and legislative authority during an economic emergency. Second, physical possession matters. The citizens who surrendered gold had no recourse when the government revalued it 1 year later. They received $20.67 per ounce. The market price became $35. They lost purchasing power permanently. Citizens who owned gold, held outside U.S. jurisdiction, kept their wealth intact. Third, the infrastructure determines control. The government did not go house to house searching for gold. It targeted the visible choke points: bank vaults, safe deposit boxes, and legal ownership records. Wealth held inside the official system was seized. Wealth held outside it was not. The prohibition on gold was not unique to the United States. Britain banned private gold ownership in 1966. France imposed capital controls repeatedly throughout the 20th century. India restricted gold imports as recently as 2013. The pattern is global. When governments face fiscal pressure, they restrict the exit doors. Gold confiscation was the template. The next iteration was subtler. Instead of banning an asset, the government built a surveillance architecture to track movement. In 1970, Richard Nixon signed the Bank Secrecy Act. The official name was the Currency and Foreign Transactions Reporting Act. The law created the first legal framework for monitoring citizens' offshore financial activity. It required U.S. persons with foreign financial accounts exceeding $10,000 to file an annual report of foreign bank and financial accounts, known as FBAR. The requirement was clear. The enforcement was not. A 2002 Treasury report to Congress revealed FBAR compliance was below 20% of an estimated 1 million obligated filers. Between 1993 and 2002, the government had only considered penalties in 12 cases. The law existed on paper. The machinery to enforce it did not. September 11, 2001 changed the calculus. Congress passed the USA Patriot Act in October 2001. Title 3 of the Act expanded the Bank Secrecy Act's reach. It gave the Treasury Department new authority to target money laundering and terrorist financing. The rhetoric was national security. The infrastructure was financial surveillance. By 2008, the IRS had a problem. It knew U.S. citizens held billions offshore. It had the legal authority to demand reporting. It did not have the data. Foreign banks were not obligated to report U.S. account holders to the IRS. The enforcement gap was structural. On March 18, 2010, President Obama signed the Foreign Account Tax Compliance Act into law. FATCA was buried inside the HIRE Act, a domestic jobs bill. Major media outlets gave it almost no coverage. The law went into effect in 2014. It transformed the global financial system overnight. FATCA required every non-U.S. financial institution in the world to do two things. First, identify which of their clients were U.S. persons. Second, report those clients' names, taxpayer identification numbers, and account balances to the IRS. Institutions that refused faced a 30% withholding tax on all U.S. source payments. The penalty was severe enough to force compliance. Over 110 countries signed intergovernmental agreements to implement FATCA. The result was a detailed list of U.S. citizens with foreign accounts. The IRS launched the Offshore Voluntary Disclosure Program in 2009. Citizens who came forward and disclosed unreported foreign accounts faced penalties but avoided criminal prosecution. Between 2009 and 2014, the program generated over $5 billion in back taxes, interest, and penalties. The IRS also pursued enforcement actions. In 2009, UBS agreed to pay $780 million in turnover, 4,150 account holder names. Credit Suisse paid $2.6 billion in 2014. Dozens of Swiss banks entered deferred prosecution agreements. The Swiss banking secrecy framework, codified in 1934, collapsed under U.S. pressure. FATCA did not make offshore accounts illegal. It made them visible. Visibility enabled enforcement. Enforcement produced revenue. The logic was simple. If the government knows where your money is, it controls access to it. The surveillance architecture expanded again in 2021. The Infrastructure Investment and Jobs Act included a provision requiring cryptocurrency brokers to report transactions to the IRS starting in 2023. The definition of broker was broad. Decentralized exchanges, wallet providers, and node operators faced potential reporting requirements. The law created confusion and backlash. Treasury delayed implementation multiple times. By 2025, the pattern was clear. Every financial innovation that allowed value to move outside traditional banking triggered a regulatory response. Offshore accounts led to FATCA. Cryptocurrency led to broker reporting rules. Stablecoins led to the Genius Act. The Genius Act, signed July 18, 2025, did something different. It did not ban stablecoins. It regulated them. It created a legal pathway for payment stablecoins backed one-to-one by reserves and issued by subsidiaries of insured depository institutions. Brookings Institution Analysis from March 2026 noted, this law established a legal bridge between traditional banking and blockchain-based financial infrastructure. At the same time, President Trump's January 2025 executive order prohibited federal agencies from creating central bank digital currencies. The distinction matters. CBDCs give the state total visibility and control over every transaction. Stablecoins, even regulated ones, operate on decentralized infrastructure. The government set boundaries but left space for alternatives. This is the current equilibrium. The surveillance architecture exists, reporting requirements are global, enforcement is real, but the legal pathways for diversification remain open. The question is not whether you report your wealth. The question is where you hold it, what form it takes, and what structure protects it. Wealthy families and institutions have used the same three strategies for centuries. The strategies are legal. They are tested. They work because they address the structural bottlenecks the state uses to control wealth. Strategy 1, geographic diversification. The principle is simple. Hold assets in multiple jurisdictions. If one government imposes controls, you have access to wealth elsewhere. In practice, this means opening bank accounts, brokerage accounts, or legal entities in foreign countries. The goal is not tax evasion. It is jurisdictional redundancy. You reduce the risk of total loss from a single government action. Examples from history are abundant. Roman elites moved wealth to Egypt during civil wars. Jewish families in medieval Europe maintained networks across kingdoms. Swiss banks provided refuge for European wealth fleeing Nazi seizure and post-war capital controls. The modern version is straightforward. A U.S. citizen opens a bank account in Singapore, a brokerage account in Switzerland, and a real estate holding company in Panama. Each jurisdiction has different legal frameworks, political risks, and currency exposures. If the U.S. imposes capital controls, the Singapore account remains accessible. If Switzerland freezes assets, the Panama entity is unaffected. Legal requirements exist. U.S. persons must report foreign financial accounts exceeding $10,000 on FBAR. They must report foreign assets exceeding certain thresholds on Form 8938. Failure to report triggers penalties. Compliance is not optional. The strategy is not secrecy. It is diversification within legal boundaries. Jurisdictions offer different levels of protection. Singapore has strong property rights and political stability, but cooperates with U.S. tax enforcement. Switzerland no longer offers banking secrecy after FATCA, but maintains robust legal structures for asset holding. Panama has favorable corporate laws, but faces reputational scrutiny after the Panama Papers leak in 2016. The choice of jurisdiction depends on your risk profile. Political risk, currency risk, legal risk, operational risk. No single jurisdiction is perfect. The strategy is to spread exposure across multiple systems. Strategy 2, asset class conversion. The principle is simple. Hold wealth in forms the state finds difficult to monitor, seize, or devalue. In practice, this means converting currency into physical assets, commodities, or decentralized instruments. Gold is the oldest example. It has no counterparty risk. It does not depend on any institution or government for value. It is portable. It is liquid. It is recognized globally. When the U.S. banned gold in 1933, citizens who held gold overseas or converted dollars into gold before the ban preserved purchasing power. Those who held dollars lost 41% when the government revalued gold. Real estate is another form. Property held offshore is harder to seize than bank deposits. It generates income. It appreciates with inflation. It requires physical presence to control. A U.S. investor who owns rental property in Portugal or Mexico has value outside the U.S. banking system. Seizure requires foreign court orders and cooperation from foreign authorities. The friction protects the asset. Cryptocurrency introduced a new category. Bitcoin, Ethereum, and other decentralized assets exist on global networks. No single government controls the ledger. No bank holds the keys. If you control the private keys, you control the asset. Seizure requires access to the keys, not a court order to a bank. The infrastructure is decentralized. The vulnerability is operational security, not jurisdictional authority. Stablecoins added another layer. They combine the stability of fiat currency with the infrastructure of decentralized networks. The Genius Act created a legal framework for payment stablecoins backed by reserves. Brookings noted, this allows dollars to exist outside traditional banks while remaining legally compliant. You hold value in a form the state monitors but does not custody. The distinction matters. Monitoring requires reporting. Custody enables seizure. The two are not the same. Art, collectibles, and intellectual property also qualify. High-value artwork is portable, appreciates over time, and trades in private markets with limited transparency. Collectibles like rare coins, watches, or antiques hold value and move across borders with minimal scrutiny. Intellectual property generates revenue streams independent of physical location. The strategy is to reduce concentration in forms vulnerable to state control. Bank deposits are fully visible and fully accessible to governments. Cash loses value to inflation. Assets the government issues or custodies are bottlenecks. Assets you custody, or assets held in decentralized systems, reduce that vulnerability. Strategy 3. Structural insulation. The principle is simple. Use legal entities and ownership structures the state finds difficult to penetrate, even when it knows they exist. In practice, this means trusts, foundations, and corporate entities designed for asset protection. The Cook Islands International Trusts Act of 1984 created the first statutory framework explicitly designed to protect trust assets from foreign creditor claims. Nevis followed in 1994. Both jurisdictions offer features U.S. domestic trusts do not. First, they do not recognize U.S. court judgments. A U.S. court order to seize assets has no legal effect in the Cook Islands. The creditor must relitigate the claim in the Cook Islands under Cook Islands law. Second, they impose a high burden of proof on creditors. Cook Islands law requires creditors to prove fraudulent transfer beyond a reasonable doubt. This is a criminal standard applied to a civil claim. The burden is nearly impossible to meet. Third, they impose procedural barriers. Creditors must retain local Cook Islands counsel. They must post bonds. They face a 2-year statute of limitations on fraudulent transfer claims. If you establish the trust more than 2 years before a claim arises, the creditor has no legal recourse. As of 2026, no U.S. creditor has successfully seized assets from a properly structured Cook Islands trust through the Cook Islands court system. The American Bar Association documented the legal architecture in published proceedings. The structure works because it shifts litigation to a jurisdiction with laws favoring the trust. Foundations offer similar benefits. Liechtenstein and Panama have foundation laws allowing families to hold assets in entities without traditional ownership. The foundation owns the assets. The founder sets the rules. Beneficiaries receive distributions according to the foundation charter. The structure is transparent to regulators but insulated from creditors. Corporate entities provide another layer. A U.S. investor establishes a holding company in the British Virgin Islands, which owns a trading company in Singapore, which holds assets in Switzerland. Each layer requires separate legal proceedings to penetrate. Each jurisdiction has different disclosure rules and creditor protections. The friction increases with each layer. Self-directed IRAs allow asset class conversion within tax-advantaged structures. A self-directed IRA trustee holds title to the assets. The account owner controls investment decisions. The IRS allows alternative assets, real estate, private equity, precious metals, cryptocurrency. The structure provides tax deferral and asset protection under ERISA. Creditors must pursue the IRA under federal law, which offers stronger protection than state law. These structures are legal. They require proper setup, ongoing compliance, and reporting. U.S. persons must disclose foreign trusts on Form 3520. They must report ownership interests in foreign corporations on Form 55471. The penalties for noncompliance are severe. The strategy is not secrecy. It is insulation within the law. March 15, 2013. Banks in Cyprus did not open. The government announced a bank holiday. Depositors could not access accounts. ATMs ran out of cash. The country faced a financial crisis. Cyprus had two major banks, Popular Bank, known as Laiki, and the Bank of Cyprus. Both banks held large amounts of Greek government debt. Greece restructured its debt in 2012, imposing losses on bondholders. The Cypriot banks took massive write-downs. Their capital ratios collapsed. The European Commission, European Central Bank, and International Monetary Fund stepped in. The Troika offered a bailout package worth $10 billion. The condition was simple. Cyprus had to close Laiki Bank entirely and impose losses on large depositors at the Bank of Cyprus. On March 25, 2013, the agreement was finalized. The Library of Congress documented the terms. Depositors with accounts exceeding $100,000 at the Bank of Cyprus lost up to 47.5% of their balances. Accounts below $100,000 were protected under EU deposit insurance. Laiki Bank was liquidated. Uninsured deposits were wiped out. This was not a tax. It was not a seizure by a court order. It was a bail-in. The Troika and Cypriot government redefined bank deposits as unsecured creditor claims. When the bank needed recapitalization, depositors provided it. The legal structure was already in place. Depositors had always been unsecured creditors. The crisis simply activated the clause. Depositors filed compensation claims. They argued the bail-in violated property rights. The European Court of Justice dismissed the claims in 2018. The court ruled the losses were necessary to preserve financial stability and were proportional to the public interest. The depositors had no legal recourse. The Cyprus bail-in sent shockwaves through global wealth management. Clients with large balances in European banks began asking questions. If Cyprus deposits were vulnerable, were deposits in Italy, Spain, or Portugal safe? If the Troika could impose bail-ins in one country, what stopped them from doing it elsewhere? The answer was nothing. The European Union adopted the Bank Recovery and Resolution Directive in 2014. The directive codified bail-in procedures across all member states. It established a hierarchy of claims. Shareholders absorb losses first, then bondholders, then uninsured depositors. Insured deposits are last. The message was clear. Bank deposits are not safe stores of wealth. They are liabilities on a bank's balance sheet. When the bank fails, depositors lose money. The government will not always step in. Deposit insurance has limits. Those limits are political, not absolute. Cyprus became a case study in wealth diversification. Clients who held all their wealth in Cypriot banks lost nearly half their savings. Clients who held wealth across multiple jurisdictions, asset classes, and structures lost nothing. Geographic diversification protected them. Asset class conversion protected them. Structural insulation protected them. The event accelerated three trends. First, high net worth individuals moved assets out of vulnerable banking systems. Deposits flowed from peripheral European countries to Switzerland, Singapore, and offshore financial centers. The outflows were legal. They were reported. They were rational responses to political risk. Second, alternative assets gained credibility. Gold prices rose after Cyprus. Bitcoin, which was trading at $47 in January 2013, hit $266 by April. The correlation was direct. When depositors saw bail-ins as possible, they moved wealth into forms governments did not custody. Third, offshore trust structures saw renewed demand. Law firms specializing in Cook Islands and Nevis trusts reported surges in inquiries. Clients wanted structural insulation. They wanted legal entities foreign courts found difficult to penetrate. Cyprus proved domestic deposits were vulnerable. Offshore trusts were the response. Cyprus was not the first bail-in. Iceland imposed losses on depositors in 2008. It was not the last. Italy restructured bank debt in 2015, imposing losses on bondholders and large depositors. But Cyprus was the clearest example of the state redefining property rights during a crisis. It was legal, it was sudden, it was precedent. The lesson is simple. When the state faces fiscal pressure, property rights become negotiable. The legal framework allows it, the courts uphold it. The only protection is holding wealth in forms and places the state finds difficult to access. You are living through a rare moment. The legal environment for wealth diversification is more permissive now than it has been in decades. 2 legislative actions created this window. One opened a door, one closed another. On July 18, 2025, President Biden signed the Genius Act into law. The full name is the Guiding and Establishing National Innovation for U.S. Stablecoins Act. The law created a federal regulatory framework for payment stablecoins. It allows subsidiaries of insured depository institutions to issue stablecoins backed one-to-one by reserves held at the Federal Reserve or approved custodians. Brookings Institution published analysis in March 2026. The report noted the Genius Act established a legal bridge between traditional banking and blockchain-based financial infrastructure. Stablecoins are now regulated financial instruments. They are not securities. They are not commodities. They are payment instruments with legal backing. This matters for 3 reasons. First, stablecoins allow you to hold dollars outside traditional bank accounts. The dollars exist on blockchain infrastructure. You control the private keys. The issuer holds the reserves. The government monitors the transactions through existing reporting frameworks. But the custody is different. A bank deposit is a liability the bank owes you. A stablecoin is a token you hold. Seizure requires access to your private keys, not a court order to a bank. Second, stablecoins allow cross-border movement without traditional banking infrastructure. You send stablecoins to any wallet address globally. Settlement is instant. Fees are minimal. No correspondent banks, no SWIFT network, no intermediaries to freeze the transaction. The infrastructure is decentralized. The government monitors it, but does not operate it. Third, the Genius Act legitimized blockchain-based finance within the U.S. legal framework. Before 2025, stablecoins operated in regulatory gray areas. Issuers faced enforcement risk. Users faced legal uncertainty. The Genius Act removed the uncertainty. Stablecoins are legal. They are regulated. They are compliant. The second legislative action happened in January 2025. President Trump signed an executive order prohibiting federal agencies from establishing, issuing, or promoting central bank digital currencies. The order was explicit. No CBDC development, no pilot programs, no infrastructure creation. The distinction between stablecoins and CBDCs is critical. CBDCs are issued and controlled by central banks. Every transaction is visible to the state. The government sets the rules for spending, saving, and transferring value. The infrastructure allows programmable money. The state could impose negative interest rates, restrict certain purchases, or freeze accounts without court orders. The Cato Institute, the IMF, and the Federal Reserve published research on CBDC architecture. The common feature is total state visibility and control. Stablecoins, even regulated ones, operate on decentralized infrastructure. The issuer must comply with regulations. Users must report holdings. But the infrastructure is not controlled by the state. The government monitors stablecoin transactions the same way it monitors foreign bank accounts. It requires reporting. It enforces penalties for noncompliance, but it does not custody the assets. The executive order prohibiting CBDCs closed the door on state-controlled digital currency. The Genius Act opened the door to regulated private stablecoins. The difference is the same distinction between owning gold and holding dollars. Gold is an asset you custody. Dollars are claims on a central bank. Stablecoins are closer to gold than to traditional bank deposits in terms of custody and control. This creates the most permissive legal environment for alternative wealth structures since 1974, when President Ford legalized private gold ownership again. The window will not stay open indefinitely. History shows the pattern. When governments face fiscal pressure, they restrict exit doors. The Bank Secrecy Act passed in 1970, FATCA passed in 2010, cryptocurrency broker reporting rules passed in 2021. Each law increased surveillance and reduced privacy. The Genius Act is different because it creates a legal pathway instead of closing one. But the pathway exists within a regulated framework. The government set boundaries. Those boundaries could tighten. 3 factors determine how long the window stays open. First, fiscal pressure. The U.S. federal debt exceeds $36 trillion in 2026. Interest payments are the largest line item in the budget. If a fiscal crisis emerges, the government will look for revenue. Exit restrictions become attractive. Capital controls, wealth taxes, and forced conversions all have historical precedent. The pressure is building. Second, geopolitical instability. If a major conflict disrupts global trade or financial systems, governments impose emergency measures. Those measures include freezing foreign assets, restricting currency conversion, and nationalizing key industries. Russia froze foreign-held assets after sanctions in 2022. China restricts capital outflows through unofficial quotas. The U.S. has not imposed controls recently, but the legal authority exists under the International Emergency Economic Powers Act. Third, political will. The current regulatory environment reflects a political consensus favoring private stablecoins over state-controlled CBDCs. The consensus is bipartisan but fragile. If a financial scandal involving stablecoins emerges, regulators will tighten rules. If a major issuer fails or a stablecoin loses its peg, Congress will respond. The stability of the current framework depends on the industry maintaining trust and compliance. You have 3 strategies available right now: geographic diversification, asset class conversion, structural insulation. All 3 are legal. All 3 have historical precedent. All 3 reduce your vulnerability to single point of failure risks. The choice is not whether to report your wealth. The choice is where to hold it, what form it takes, and what structure protects it. The government will always demand visibility. The question is whether visibility equals custody. Right now, the law allows you to separate the 2. You report your holdings, but you control access. This is the exit strategy. Move value outside systems where the state has total control. Use jurisdictions with legal protections. Hold assets the government finds difficult to seize or devalue. Structure ownership through entities foreign courts find difficult to penetrate. The wealthy have done this for 4,000 years. The strategies are not new. The legal frameworks are. The Genius Act created a new tool. The executive order on CBDCs protected a boundary. The tools exist. The window's open. The question is whether you use it before it closes.